So welcome, my name is Mr. John Mark, a lecturer at KCE. I'll be taking you through today's session, that's Advanced Management Accounting. And today we cover a topic called performance evaluation. And we'll be doing the following question from the past paper. These are the questions we'll be doing. We'll be doing May 2016, question 5B, May 2018, question 5A, September 2015, question 1, and May 2015, question 5B. So those are the questions we'll be doing from the past paper, customer past paper. So I urge you, you'll be having your past papers with you and the notes with you. So now under this topic for performance evaluation refers to the exercise of comparing the actual and the expected performance. That's what we call performance evaluation. And the major objective of performance evaluation is to ensure that the original objective of the business of the company is being implemented. So that's the primary objective. Then the secondary objective is to form a basis of either to reward or to punish the subject of the appraisal. So in this case, that the primary objective is to ensure that the objective of the business is being implemented, and the secondary objective is to form a basis of either to reward or either to punish the subject of the appraisal. So what are the major methods used when evaluating performance? So we'll be looking at three major performance evaluation methods. One is the return on investment. Number two, we have residual income. And number three, we have economic value added. We shall be evaluating each at a time. But mostly just to give you a summary, return on investment is mostly preferred when performing what we call investment appraisal method, or when you are evaluating a project. Then residual income is mostly preferred when evaluating managerial performance. And then economic value added, it's mostly used for evaluating departmental performance, either to determine whether the department has added value or destroyed value. So let's start with the first one, which is the residual return on investment. That's ROI. And return on investment, this will show the amount of returns generated by a given investment over a defined period of time. So that's how we get the return on investment. And return on investment, for example, if you invest 1 million, and then at the end of the year, you determine how much is your profit. So to determine the return on that investment, you take that profit, you divide by the capital you had invested. So that's how you get return on investment. Is that simple? And then ROI is preferred for economic performance measurement. So that's very important. Yeah, it's applied or it's preferred when performing economic performance measurement, and also comparison of dissimilar units when the different units are operating at different autonomy, or they're operating independently and then they are dissimilar. And then when used in appraising the project, when you use return on investment to appraise the project, you should only accept the new project if its return on investment is greater than the existing company return on investment. So what do we mean? For example, you're having a project or the company has a return on investment of 10%. So when you want to evaluate new projects to undertake, only accept the project whose return on investment is greater than the existing company return on investment. That's 10%. Assuming the company has a 10% return on investment. When you're evaluating a new project, for you to accept new project, its return on investment should be greater than 10%. If it's less than 10%, you should not accept that project. So that's all about return on investment. And how do we compute return on investment? That's how we compute return on investment. That's how we compute return on investment. So you take the operating income, you divide by the total assets, and when not given the total assets, you divide by the capital, and then you multiply by 100%. Or there is another method known as the DuPont method. And the DuPont method, you just take the operating income, you divide by sales, you multiply by sales, divide by the total assets times 100. Of which the two methods, they are the same. Because, let's look at this. If you cancel sales and sales, you remain with income divided by the total asset, which is the same as that. But sometimes the examiner may be specific using the DuPont method. So that's why I'm giving you the two different formula you can use. So that's all about return on investment. Now let's go to method number 2. Method number 2 is what we call a residual income. And what's residual income? Now, residual income, when you talk about the residual, it's just something which is in excess. So, residual income, this is the excess profit over the cost of capital. And this will determine the return on the residual income. So, residual income, you just take the operating income, you deduct cost of capital. And where do you get the cost of capital? To get the cost of capital, you just take, for example, if you're given the cost of capital is 10%, you just take that 10% of the investment or the capital which you had invested. That's what determines the cost of capital. And then, residual income is preferred for managerial performance evaluation. So we have seen that for return on investment, it's preferred for economic performance measurement. But for residual income, it's highly preferred for managerial performance evaluation. So how do we make the decision when using residual income? So the new project should only be accepted when the residual income is greater than the cost of capital. If the computed residual income is greater than the cost of capital, you accept. Or when the residual income is positive. If your residual income is positive, that means the residual income is greater than the cost of capital. So in that case, that's when you should accept. So only accept when residual income is positive or when the residual income is greater than cost of capital. Good. So now before we look at number 3, that's the economic value added. I want us to do some illustration now focusing on the two. Return on investment and residual income. So you may look at that. Good. So I want us to do a question from the handout. For those with the notes, the question is already there. It's a handout. Or those with the handout, the theory handout, with some question, they can open that question at page 16. Page 16, or those with the notes, the question is already written there. Let's do that question. Let me read the question. And we are told that Kameme Media Group has 3 major divisions. That is newspaper, television, and film studio. Summary of the financial data in millions of shillings for year 2015 and 2016 are given as follows. So we have operating income for the 2 years, 2015 and 2016. We have the revenue, and we have the total assets for both the newspaper, television, and film studio. The manager of each division has an annual bonus paid, has an annual bonus plan based on division return on investment. And the company has defined return on investment as operating income by the total assets. The last paragraph, Mark, the manager of the newspaper division, is considering a proposal to invest 200 million in fast speed printing process with color option. The estimated increment to year 2017 operating income would be shillings 30 million. And the media group has a 12% required rate of return for investment in all the 3 divisions. Required. Number A. Using the DuPont method to explain the difference among the 3 divisions in the year 2016 return on investment and residual income, in bracket, we are told that use 2016 total assets as denominator. Good. So we start with that number A. So number A, you are supposed to determine return on investment using the DuPont method. So how do you compute that? So now this is how you present. So we have 3 divisions. We have newspaper, we have television, and we have film studio. So how do we compute return on investment using the DuPont? We have said that using DuPont, return on investment, you take the income, you divide by the sales or the revenue, you multiply by sales, you divide by the total asset, you multiply by 100%. So that's how you compute. So in this case, we can do this. First of all, we determine income, you divide by the sales, we get that. Then you multiply by sales divided by the total assets, like that, so that now we can be able to compute return on investment. As simple as that. So, what do we have? So let's start with the first one, income over sales, and then we say that we are supposed to use for year 2016. That's what we are told, using year 2016 as denominator. So now let's start with the income over sales for newspaper. For the newspaper, the operating income was 1100. For television, operating income was 160. And remember, you are using for 2016, And then the other one was 200 for film studio. And then you divide by sales. Let's go to the revenue for year 2016. For newspaper was 4600. For television, it was an amount of 6400. And film studio was 1650. Like that. So what do we have there? So 1100 divided by 46, you have it's 0.24. 160 divided by 6400, it's 0.025. 200 divided by 1650, it's 0.121. Then we go to the second one, sales over total assets. So in this case, you take the sales, and we have our sales. For newspaper, how much was the sales? Was 4600. For television was 6400. And for the film studio was 1650. And then we divide by the total assets. How much was our total assets? For newspaper, 2016 was 4900. Television was an amount of 3000. And for the film studio was 2600. So what do you have there? So 4600 divided by 4900, the one you get is 0.939. For television, it's 2.123. And for film studio, it's 0.63. So now let's get the return on investment using dew point. You just take that, you multiply by that, times 100. So for example, for the newspaper, you'll take 0.24. You multiply by 0.939, you multiply by 100%. So here you'll take 0.025, you multiply by 2.123 times 100%. And lastly, here you'll take 0.121, that you multiply by 0.63, you multiply by 100%. And what do we get there? So you'll have 22.54. Here you'll have 5.33%, and there you'll have 7.623%. So that's what you got as your return on investment. So now I want us to use the same information. What if now you are supposed to get the residual income? Let's determine residual income. And he said, how do we get the residual income? We said residual income, you just take your incomes, write for you the formula, that residual income, you take the income minus cost of capital. Is the income minus cost of capital. So now let's compute for each. We start with the newspaper. For the newspaper, we are doing for 2016. How much was the income? Our income was how much? That's the operating income, was 1100. I deduct cost of capital. We deduct cost of capital. And we are told that, that's the last paragraph, last sentence. The media group has a 12% required rate of return for the 3 division. So to get the cost of capital, just take 12% of capital. How much was the capital? And whenever you're not given the capital, use the total assets. And the total assets for newspaper division was 4,900. For television, you'll take 160. That's the income. You minus the cost of capital. So it is 12% of the total assets or the total capital. So based on what you're given. So in this case, you are given it's 3,000. And lastly, Here we have 200. You deduct 12% of the total assets, and the total assets here was 2600. So what do we have as our residual income? So here you have 512. There you'll have negative 200. And there you'll have a negative 112. So that's how you determine residual income. So in case you are told to make a decision whether to accept or whether to reject, remember you already told that the company, the group media has 12% required rate of return on investment. The group has required rate of return on investment of 15%. So based on the return on investment, we want to determine which project to accept. This one is more than 15, so you can accept a newspaper, but television is 5.33. And then what about film studio? It's 7.6. So you see they are underperforming, but newspaper is performing better. Residual income, we say that when evaluating the performance, the one with a positive value is doing better, and you should accept the one having a positive value. But the good thing in this case, we are not evaluating new project, the existing project. So 512, that means this project is doing great. This one is not doing any great. Even this one is not doing good because they are negative. So let me go to part B of the question. Part B of the question, we are told that. Let me read for you part B question. Or before that, I want to read the last paragraph. The last paragraph, we are told that Mark, the manager of the newspaper division, so the newspaper division, is considering a proposal to invest 200 million in fast speed printing process with color option. The estimated increment to year 2017 income would be 30 million. So the income will increase by 30 million if we invest 200 million. So now let's go to the required number B. Number B, I told that. Explain whether Mark should undertake the fast speed printing press investment proposal. So we need to advise whether he should accept. So for the newspaper, so now let's start with the residual income. We said how to get the residual income. You just take the income over total assets or the capital times 100. And we are told that for the newspaper, you need to invest an amount of 200 million. And we are told that the incremental earning for year 2017 will be 30. So our income will increase by 30. But capital will have to invest 200 million. Then times 100%. So how much will be our return on investment? So and our return on investment will be 15%. So you ask yourself, you see it's 15%, and you see the newspaper initially had the current existing return on investment is 22.54. But if we invest in the new project, it will only give us 15%. So in that case, we should not accept. Why? Because the computer return on investment is less than the existing return on investment, which is 22.54. Or you can still do this. Or you can still do this. Let's do this. Let's do this. We are evaluating for newspaper. How much was the income for newspaper? The total income. The total income for newspaper, it was an amount of 1,100. That was the income. You add, if we invest in the new project, the incremental earnings will be 30 million. You add 30, you divide by, now that will be the total income. You divide by the capital. How much was the capital, initial capital of the newspaper? That's the total assets, and the total asset was 4,900. Then you add, if we invest in the new project, we'll have to invest an additional 200 million. 200, you multiply by 100%. How much will you get? So with that, you'll get 22.03%. So you ask yourself, if you use this, you see, if you combine the two, existing, we had 22.54. But if we incorporate the new project, what has happened? 22.03. Has it increased or has it gone down? So it has gone down. So that means the new investment proposal is not viable. When using the return on investment, it's not viable. Good. But in case you are told to evaluate using the residual income, we have said that residual income, you just take the income minus cost of capital. If evaluating using the residual income even if you are getting a small profit, you should accept. So we are told that it will give us an incremental income of 30 million minus cost of capital. How do we get the cost of capital? You take 12% and we're investing 200 million. And in that case, you'll get 6. So based on the residual income, since we are getting a positive value, we should accept since we are getting a positive value. So you can look at that question now. So let's try another illustration from the past paper. Take out your past paper and open May 2016, question 5b. May 2016, question 5b. You can even start with part A of the question. Part A, you are told that discuss the application of Fitzgerald-Edmund-Block model in performance measurement with particular focus on service organization. So 10 marks. So now, this question, from the handout I have already indicated there, and also from the notes, I have indicated the application. Actually, I have drawn it in terms of in form of a graph. So in that case, you can be able to follow it. I have already provided that. It's already there in your handout or in the notes. So now let's go to part B of the question. And part B, you are told that the following information are related to investment opportunity available to Tumaini Limited. So we have an investment opportunity from A, B, C, D, and E. Annual profit and the cost of investment. Additional information. The company currently has a profit of $1,250 and investment of $5 million. Number 2, the minimum required rate of return of the company is 20%. The company will only invest in the project that will improve the current performance. So let's repeat number 3. The company will only invest in the project that will improve on the current performance. If the current ROI is 10%, you should only invest in the company which return on investment is greater than 10%. Good. Required, number 1, return on investment and residual income for each of the investment opportunity. So return on investment and residual income. So before I evaluate that, I want us to go back to additional information number 1. Additional information number 1, we are told that the company currently has a profit of $1,250 and investment of $5 million. That's currently. So if you want to determine the current ROI, the current return on investment of the company, we are told that the company has a current profit of $1,250. So just take $1,250. So first of all, let me write for you the formula. We said, how do you get the return on investment? Return on investment, we say that you take the income, and the income is the same as profit. You divide by the total asset, and whenever you are not given total asset, you use capital. So we are told that additional information number 1, that the company currently has a profit of $1,250, that's our income. You divide by the total assets and investment of $5 million. So investment is the same as the total asset or the capital. So you divide by 5,000, you multiply by 100% for you to determine the current return on investment. And in that case, you have is 25%. So that means for you to invest, you see in this case, we're evaluating new investment opportunity. For you to accept the new investment opportunity, you should only accept the project whose return on investment is greater than 25. So now let's compute for each. So we have investment there, or the project. We have project A, B, C, D, and E. And then we want us to compute ROI. And then we compute residual income. We said, how do you get the residual income? It's all about the income or the profit minus cost of capital. So let's evaluate each. We start with the return on investment. Return on investment. So how do you get return on investment? We have said that you take income, you divide by the total assets. So we already given the annual profit. For A, it's 300,000. For B, it's also 300,000. C is 240. D is 280. And E, we are given 260. That's the income. You divide by total assets or the investment. And in that case, you are given the cost of investment. Project A cost of investment is 900,000. The other one is 1.6. The other one is 1.2. The other one is 800,000. And the other one is 1 million. and then you multiply by 100%. So what do we get there? So this one you get that 3%, the one you get 19%, 20%, that 5%, and 26%. So now, let's now evaluate those projects, the new investment. Which one to accept, which one to reject? Remember the current company return on investment is 25%. So, project A, should we accept or we should not accept? So, that 3 is greater than the existing 25. So, that one you should accept. Project B, you should reject because 19 is less than 25. Also, project C, you should reject. Project D is 35. 35 is greater than 25, so you should accept. And project E also you can accept because 26 is greater than 25. And in case you are taught rank, which project will you give the first priority? So project A is giving us that 3. Project D is 35. So I think that you start with the project D, then followed by A, E, then C, number 4, and number 5. So that's all about the residual income. Now let's determine our residual income. How do we get the residual income? We say that residual income, you take the income, you deduct the cost of capital. And how much was our income? Our income, we had 300 for project A, 300 for project B, 240, 280, and 260. Then you deduct cost of capital. How much is the cost of capital? Let's go to additional information number 2. Additional information number 2. Number 2, you are told that the minimum required rate of return of the company is 20%. So, to get the cost of capital, you take 20% of the capital. 20% of the capital. And how much was the capital? The capital for project A was 900,000, 1.6, 1.2, 800, and 1 million. So like that. So, and with that, what do we get? So you have 120. So that is negative 20. That is 0. That's 120. 260 minus 200, that is 60. So now let's make a decision. Which one to accept, which one to reject. You see that based on the residual income, accept if the residual income is greater than the cost of capital or when it's positive. So project A is positive, you should accept that. This is negative, should reject. 0. But you get a 0. Should you accept or should you reject? Yeah, you may think that is point of indifference, either accept or reject. But in this case, it was very clear. Let's go to additional information number 3. Number 3, we are told that the company will only invest in the project that will improve on the current performance. So if you get a 0, that means it's not increasing any performance. So automatically you should reject it. 120 is a positive, you accept, you accept. In case you are taught rank the project, which one will you give the first priority? So we have 120, 120, you can start with either, but I can start with D because based on the return on investment, it was ranked number 1. Then the other one, number 2, number 3, number 4, number 5. So we look at that. And then number 2 of the question, we have computed number 1. Number 1, you are supposed to get the return on investment and residual income. Number 2, you are told that based on the performance measures above, rank the investment opportunities in the order of their preference, of which we have already ranked them. Then comment on the project or the projects that the company should invest in. And already we have already commented which one to accept, which one to reject. So look at that question well. We can try on another question. Open this question. May 2018 question 5A. May 2018 question 5A. So let me read the question, and we are told that ACE Limited has two divisions, namely B and C, each under divisional manager. The two divisions plan to acquire some investment in the month of August 2018. Additional information number 1. The cost of capital for both the divisions is 13%. Number 2. The current return on investment of each division is 15%. Number 3. The division's planned investment have the following features. So we're given for both B and C, we have the capital required for investment, revenue generated, and then we have the net profit margin required. For each of the two divisions, number 1, you determine the return on investment, and number 2, residual income. So number 1, so we are doing May 2018, question 5, part A. And required number 1, you're supposed to get this return on investment. How do we get this? Is the income, and we said the income is the same as profit. You divide by the total assets, and whenever you don't have the total asset, you take the capital times 100. And then we have two projects here. So we have project B and C. Project B and C. So in this case, how do we determine our income? So in this case, most of the students fail this question because they use revenue as the income. No. For you to get the income, we say this is the same as profit. You are given the net profit margin. For B, the net profit margin is 30, and the other one is 35. Then you multiply by the revenue, because that's the net profit margin. The revenue for B was 450,000, and for C, revenue was 210, so that you can determine the income. So how much will be the income? So 30% of 450, it will get it's 135,000, and for C, it's an amount of 73,500. So now let's get the return on investment. For B and for C, you're saying that you take the income, and income for B it's 135,000, and for C it's 73,500. Then you divide by total assets of the capital, and you're given the amount of capital. How much was the capital for project B? B capital required was 800,000. Divide by 800,000 times 100%. For C, the capital requirement is 400,000. Then you multiply by 100%. And how much do you get? So this you get is 16.8%. And the other one is 18.3%. So that's what we have. Then, number 2, we are supposed to get residual income. How do we get the residual income? You take the income, you minus the cost of capital. So we have B and C. So income we have already computed. For B, our income is 135,000, and for C, it's 73,500. Then you minus the cost of capital. And how much was the cost of capital? That's additional information number 1. Number 1, you're told that the cost of capital for both the division is 13%. So you take 13% of the capital. Project B, the capital was 800,000, and project C was 400,000. So what do you get? So here you have it that 1,000, and the other one you have it's 21,500. As simple as that. So you need to be very keen with this topic. This is a topic that never misses in each sitting for management accounting. So that question never misses. So now let's look at the third method. We already looked at residual income and return on investment. Now I want us to look at the third method we can use to evaluate performance, which is the economic value added. And the economic value added is the difference between the net operating profit after tax and the return on capital employed. And when you talk about the net operating profit after tax, When you're talking about that operating, that case, it means that we don't consider the interest aspect. So that's what we call a net operating profit after tax. And it's applied in evaluating division performance, in order to determine whether they are either adding value or destroying value to that entity. So the major objective is to determine whether they are either adding or destroying value. And it's computed as follows. This is how to determine the EVA. You take the net operating profit after tax, you deduct return on capital employed. We indicated there, net operating profit after tax minus capital employed. Now, when determining the net operating profit after tax, remember you'll be using the financial statement. What you usually do, you just take the profit after tax, you add back all the disallowable expenses. And in this case, for example, you need to add back the interest. Because for the net operating, we are not considering the interest. Because interest is not part of operating, it's part of financing expenses. Then you deduct the return on capital employed. Now, for the return on capital employed, number one, you have to determine the amount of the capital. And then you multiply by the cost of capital. And how do you adjust for the capital? Later I'll show you how to adjust for that, show you how we do the accounting adjustment. So what are some of the advantages of using EVA? Number one is that EVA is a true indicator of the actual wealth created for the shareholders. Another thing is that it's a good measure of performance, because we have seen in this case determining whether they are adding or destroying value. And then it's simple to understand and to explain to managers. And then another advantage is that it uses cash flows, and which is less easier to manipulate. It will be using cash flows. So that means non-cash item will not be adjusted in this case. And then EVA is consistent with the objective of maximizing shareholders' wealth. Because EVA, we are determining how much value has it been created. Yeah. And then what are some of the disadvantages? What are some of the disadvantages? Some of the disadvantages. One of the major disadvantages is that it can be complex, mostly when there is involvement of large transaction. And then it's based on the historical information, then cannot be used to forecast the future flow. And then also it's not suitable for small enterprises with no different divisions. So that means EVA is only mostly applicable for the large organization. Then we have said that when determining the net operating profit after tax and we're determining the return on the capital employed, we have some adjustment. We need to do what we call the accounting adjustment. And what are those some of the accounting adjustment? And this is very important, mostly when you're adjusting for that. Number one, interest on the debt capital should be added back. And it should be added back to the profit after tax, net of tax. Remember, it's always allowable for tax. You add it back. For example, if you're given the profit after tax, you add back the interest, net of tax. Then, non-cash expenses should be added back to the profit after tax. Why are we adding back? Because we have said that EVA uses cash flow and not the profits. So in this case, if in case you have any non-cash expense, you add it back. Also, depreciation, amortization, and impairment should also be added back. Remember, impairment and depreciation, they are just provisions. They are not actual cash flows. So in this case, they should be added back and computed on an economic basis. When we say that computed on an economic basis, instead of providing depreciation, economic basis for depreciation is what we call wear and tear of the capital allowances. So in case of this, you add back the depreciation and amortization, then you raise wear and tear of the capital allowances. That's what we mean when we say that. You add them back and compute on an economic basis. Then, depreciation should be added back to capital. I mean goodwill, because goodwill forms, it's part of the shareholder's wealth. So it should be added back to the capital. And that one we add to the capital, we are adjusting for the return on the capital employed. And then lastly is that marketing and advertising expenses, research and development costs, and goodwill written off should be added back to profit after tax and then capitalized. Remember some expenses such as marketing and advertising, research and development costs, they are what we call their long-term expenses. They are not just recurrent expenses. They are not operating expenses. Therefore, they should be added back to the expenses and then they should be capitalized. So those are the sum of the accounting adjustment. You can look at that so that we can try a question from the past paper. Good. So I want you to open this question. Open September 2015. September 2015, question 1A. Yeah, so let me read the question. And we are told that, question 1A. Langaranga Limited was privatized 3 years ago. The board of the directors are trying to enhance performance for the benefits of shareholders. The board has introduced the use of economic value added as a key performance indicator. The following information is available for the year ended 30th June 2015. So you're given that information. Number 1 is the income statement, where you have sales, operating cost, operating profit. Then we have finance cost, profit before tax, corporate tax is 30%, and then we have the profit after tax. Number 3, statement of financial position indicates capital employed as at 1st July 2014 of 1060 million. Number 3, operating cost includes research and development cost, depreciation, goodwill amortized, advertising cost. Number 4, goodwill written off in previous years amounted to 34.5 million. Number 5, economic depreciation is approximately 114 million. Number 6, cost of capital is as follows: equity 18%, debt 10%, and debt to equity ratio is 60%. So you're given that information to determine the cost of capital. And number 6, we're told that the cost of capital is as follows. You're given for the equity and for the debt, and the debt to equity ratio. So how can we get the cost of capital? When you have the cost of the equity and the cost of the debt. So you just get the average. And to get the average, you use WACC. Weight of equity, cost of equity. Weight of the debt, cost of the debt, 1 minus tax. And we are told that debt to equity ratio is 60%. So that means the weight of the debt is 60%. So weight of the debt is 60%. That means the weight of the equity will be 0.4. So weight of equity, cost of equity, and the cost of equity we are given is 18%. Plus weight of the debt, which is 0.6, times the cost of the debt. Cost of the debt is 10%. Then 1 minus tax rate. We are told that the tax rate is 30%, 0.3. So what do you get as our WACC? So you have it's 11.4%. So that's the first step. You have to determine the cost of capital. Good. So now with that, how do we get EVA? Because the requirement was required. Calculate the company's performance using EVA. And we say that EVA is NOPAT, or net operating profit after tax, minus return on capital employed. So now let's present the EVA statement. So first of all, you start with net operating profit after tax. So in that case, you always start with the profit after tax. How much was the profit after tax? Let's go to additional information number 1. The profit after tax given there, it's 53.9, and our shillings are in millions. Just remember, you're getting net operating profit after tax. You take the profit after tax, now you adjust. And how do you adjust? So to the adjustment, you add back the non-operating expenses and non-cash expenses. So now let's go back to the income statement. Let's go back to the income statement. You start downwards. From profit after tax, we work upward. So we add all the non-cash expenses, including the interest. So, number 1, so after tax, we have profit before tax, we have finance cost. So you add back finance cost. Remember, finance cost is the same as interest. So finance cost, how much was the finance cost? Finance cost was 38. 1 minus 0.3. Why? So let's be here. Accounting adjustment number 1. Number 1, we say that. Accounting adjustment number 1, we say that. Accounting adjustment. Interest on debt capital should be added back net of tax. So you should add them back net of tax. And what do you get there? So you have is 26.6. You add it back because we are looking at net operating. And tax, the interest is not part of operating. So that's why we are adding it back. Then see that note number 1 to the income statement. We have operating profit, then we have operating cost. So for the operating cost, let's go to note number 3. Number 3, we are told that operating costs include, number 1, research and development costs. Remember, we see that research and development costs, marketing and advertising expenses should always be added back. So we have research and development costs, you add back. Research and development cost, an amount of 20, you add it back. Then we have depreciation. Also, we say that depreciation, impairment should always be added back. They are non-cash expenses, an amount of 98. Then we also have goodwill amortization. They are non-cash expense, they are just provision, which is 11.5. Also, we have advertising expenses. Advertising cost. We say that the marketing and advertising cost also should be added back. And then we deduct. Let's go to note number 5. At note number 5, we are told that economic depreciation is approximately 114. Erase economic depreciation. It's an amount of 114. Let me explain this. I said that one of the accounting adjustments is that depreciation, impairment, and amortization should be added back and computed on an economic basis. And we say that economic basis, that means it's more of capital allowances. So I have added back all the depreciation and amortization, and then you compute them on an economic basis. And we are told that the economic depreciation is approximately 114. So this one is treated as more of the capital allowances. So with that, what do you get as now NOPAT? Our net operating profit after tax, after all the adjustment, will be 99.5. Like that. So now we are through with the NOPAT. Now we look at the capital employed. How do we get the capital employed? So you just take the capital balance brought down. Let's go to additional information number 2. Additional information number 2. We are told that statement of financial position indicates capital employed as at 1st July 2014 as 1060 million. We have 1060. Then, what increases the capital? We said that. Let's go back there. Number 4, one of the accounting adjustments, we say that goodwill should be added back to capital, because we say that goodwill increases the value of the capital to the shareholder. It's the shareholder's wealth. So, capital balance brought down, then under adjustment, for the adjustment, we add back goodwill. How much was the goodwill? You are not given how much was the goodwill. You are not given, but we can be able to determine how much was the goodwill. Let's go back. Note number 4. At note number 4, you are told that goodwill written off in previous years amounted to 34.5. So goodwill written off in previous years was 34.5 plus, let's go back to note number 3. Note number 3, we have good amortized. That was the goodwill amortized during the year. And goodwill amortized during the year was 11.5. Now, this is what I have done. Since we are not given the value of the goodwill, but already given the goodwill written off in previous years and the goodwill written in the current year, if you add the two, you can be able to determine how much was the actual goodwill before it was amortized. So that 4.5, you add 11.5, and you have an amount of 46. So that means the original goodwill, before it was amortized, was an amount of 46. So how much do you get there? So you have 1106. So now that's the adjusted capital. So now let's get EVA. How do we get EVA? We say that to get EVA, you take the NOPAT, or the net operating profit after tax, which is 99.5, minus return on capital employed. How do we get the return on the capital employed? You take the cost of capital times the capital. So let's go back here. How much was the cost? Our WACC, that was the cost of capital. Our WACC was 11.4%. So it's 11.4%. 11.4% times the capital. And the capital, it's 1106. So what do you get as economic value added? You take the NOPAT minus return on capital employed. The capital employed is 1106, and the cost of capital, the return, is 11.4%. And in that case, you'll have negative 26.58, which is a negative. So with that we can comment. Is management of Langalanga division adding or destroying value? So if this is negative, that we say that the management of Langalanga Limited is destroying value because they are getting a negative. So you may look at that question. So let's try another illustration. Let's try a last illustration on economic value added. Open with me May 2015. May 2015 question 5B. May 2015 question 5B. So let me read the question. I read the question. The summary of the financial information for Great Group Limited is as follows. So you are given 2 years, 2013 and 2014. We have the revenue, profit before tax, income tax, profit for the period, dividend, and the retained earnings. And then we have non-current assets, we have all that. Additional information. The capital employed as at the end of year 2012 amounted to 279. So in this case, we have year 2013 and we have 2014. But you know that number one, the capital employed as at year 2012. Now remember, the capital for year 2012 becomes the opening capital for year 2013. And the capital for 2013 becomes the opening capital for 2014. So that's why you're given that information. Then number two, you are told that Great Group Limited has an uncapitalized risk valued at 16 million in each of the year 2012 and 2024, which were not subjected to amortization. So it was an uncapitalized risk. So when you talk about uncapitalized, we need to capitalize it. How do we capitalize it? By adding that risk to the value of the capital. Then number three, amortization of goodwill amounted to 5 million per year in both year 2013 and 2014. Remember, we said amortization, we add it back. It's an uncash expense. It's just a provision. The amount of goodwill written off against the reserve on acquisition in the year prior to 2013 amounted to 45. Those were the goodwill written off. Number four. Great Group Limited pre-tax cost of debt was estimated at 10% for both year 2013 and 2014. That's the cost of the debt. Then number five, the group cost of equity was estimated at 16% in year 2013 and 18% in year 2014. Then the target capital structure is 50% equity, 50% debt. So first of all, let's get the cost of capital. This is how we get the cost of capital. We are given the cost of the debt and the cost of equity. So to get the cost of capital, you get the average. WACC is the weight of equity, cost of equity, plus weight of the debt, cost of the debt, 1 minus the tax. We have year 2013 and we have year 2014. We are told that at note number 6, the target capital structure is 50% equity, 50% debt. So weight of equity is 0.5 times cost of equity. How much is the cost of equity? Note number 5. At note number 5, you are told that the group cost of equity was estimated to be 16% in year 2013 and 18% in year 2014. So it's 16 and 18%. Then you add weight of the debt, it's 0.5 times, let's go to note number 4. Number 4, you are told that Great Group Limited pre-tax cost of the debt was estimated to be 10% for both years 2013 and 2014. So it's 10, which was pre-tax. Then you tax 1 minus tax rate. We are given tax rate is 30%, 0.3. So how do we get as our WACC or our WACC? So it's 11.5% and we have 12.5%. So that's the first step. Now let's continue at note number 7. The tax rate was 30% for both year 2013 and 2014. Number 8. The economic depreciation. Remember I said that economic depreciation is more of wear and tear. Economic depreciation amounted to 40 million in year 2013 and 45 million in year 2014. The amount were equal to the depreciation used for the tax purposes and depreciation charged to the income statement. Number 9. Interest payable amounted to 6 million per year for both year 2013 and 2014. That is the interest payable. And he said that interest should be added back to the profit after tax and it should be net of tax. And then number 10. Other non-cash expenses amounted to 12 million per year, both 2013 and 2014. Required. For both the years 2013 and 2014, estimate the economic value added, 10 marks. So let's present our EVA statement. And we have 2 years. We have year 2013 and we have year 2014. So let's start with the profit after tax. We want to determine the net operating profit after tax. So let's go to the income statement. Under the income statement, we have the revenue, profit before tax, income tax, profit for the period. That's what we want, profit for the period after tax. For year 2013, it's 67. For year 2014, it's 82. And then we adjust. So let's do the adjustment. How do we adjust? Number one, we add back the interest. And the interest should be the net, or should be net of tax. Let's go to note number 9. Note number 9. Note number 9, you are told that interest payable amounted to 6 million per year for year both 2013 and 2014. So the interest was about to be 6. And it should be net, we said it should be add back net of tax. However, you multiply by 0.7. So what do you get there? So it's 4.2. 4.2. Then note number 10. Number 10, you are told that other non-cash expenses amounted to 12 million per year for both the year 2013 and 2014. Non-cash expenses, you add back. So non-cash expenses, remember you are dealing with the cash flows. It was 12 million each year. Then we also have depreciation. How much was depreciation? Depreciation. Let's go to note number, not depreciation, but rather amortization. Let's go to note number 3. Note number 3, we have amortization. Number 3, we are told that amortization of goodwill amounted to 5 million per year for both the year 2013 and 2014. So we have 5. What else do we have there? Then you deduct economic depreciation. It's more of wear and tear. And let's go to note number 8. Number 8, you are told that economic depreciation amounted to 40 million in year 2013, 40 million in year 2013, and 45 in year 2014. Like that. Don't think we have any other adjustment. So with that, now we have our no part. And in year 2013, our no part is 48.2. And in year 2014, we have an amount of 58.2. Then we go to the other part, capital employed. Capital employed. Let me repeat again. Can we go back to note number 1? Additional information number 1. Number 1, we are told that capital employed at the end of year 2012 amounted to 279. That was 2012. But in this case, we have 2013 and 2014. Now, the closing capital for 2012 becomes the opening capital. That's what was invested in at the beginning of year 2013. So at note number 1, the capital for 2012 was 279. Then the closing capital for year 2013 becomes the opening capital for 2014. So now let's go to the statement of financial position there. Statement of financial position. In year 2013, the capital employed was 340. For 2013, you reported to 2014. Then the one closing for 2014 will be the one which would be invested at the beginning of year 2015. Good. Now with that, we go to the adjustment. One of the adjustment is that note number 2. Note number 2. We are told that note number 2. Great Group Limited has an uncapitalized lease valued at 16 million in each of the year 2013 and 2014, which were not subjected to amortization. There was an uncapitalized lease, so that means you capitalize it. Leases. You capitalize by adding it back to the capital. So it was an amount of 16. Good. Then, we also add goodwill. Let's add back goodwill. Remember we said that goodwill is the shareholder's wealth. Let's go to note number what? Note number 3. Note number 3. At note number 3, we are told that At note number 3, we are told that amortization of goodwill amounted to 5 million per year for both the year 2013 and 2014. The amount of goodwill written off against reserve on acquisition prior to year 2013 amounted to 45. Prior to 2013 was 45. That was the goodwill written off. So what does that mean? So goodwill, we add back 45. So we add 45. We add 45. Like that. So now we get our adjusted capital. How much is our adjusted capital? So we have it's 340. And there we'll have it's 401. So now with that we can determine our EVA. Let's determine our economic value added. So how do we get EVA? For both the year 2013 and 2014. We say that to get EVA, you take the net operating profit after tax, and our net operating profit after tax in year 2013 it's 48.2. The one is 58.2. Then you deduct return on capital employed. Return on capital employed, you take the cost of capital. So you had already computed the cost of capital there. 2013 was 11.5. And the other one was 12.5. You multiply by the capital. So here capital we have it's 340, 401. Good. With that now we can be able to determine how much will be our EVA. So here we have an amount of 8.02, and here we have an amount, it's 18.72. The other one we have it's 7.02. So that's how I compute the EVA. So now you can look at that. So that one we can comment that in 2013 and 2014, you see, since we are having a positive value, that the management are adding value. Management is adding value. So now with that, that marks the end of today's session. Thank you for your time. I hope you keep on revising. Remember, we have said that this topic for performance evaluation never misses in each and every sitting for advanced management accounting. Thank you for your time.